Hello. As you know, I am Carla Zevnik-Seifster, both president of ClearStep Financial and also an advisor for many of you. And alongside of me today is one of our other advisors that I work closely with, and that's Nathan Olson. Nathan joined our firm a few years ago, and we're very pleased to have him with his caliber here in our team. So now we would both like to welcome you to today's presentation, Mastering Money, the Financial Basics Made Simple. And as many of you may already know, our goal at ClearStep Financial is to help educate and teach and guide our clients through our ever-changing financial world. How many of you realize we're changing? Things are changing, money's changing, financial pictures are changing, markets are changing. We have a lot of volatility out there. And as always, I believe you will find this information, though, very educational and informative. And with that, let's start our presentation. So our focus, if we can go back one, Nathan, our commitment is to be with our clients every step of the way. We believe we are the financial advisor. We are committed to our clients, helping them with their financial goals. And so there's the accumulation phase, which is where people are saving money. There's the preservation phase. So usually within 10 years of retirement, people really look at the preservation. They still want to grow the money, but we also want to consider helping to preserve the asset. But then we're looking at the distribution phase, which for many people is retirement. That can be any age. Whenever you have a large enough pot of money to be able to take a withdrawal, that could be retirement. So that could be any age. But our passion is to educate and teach about money and finance, and that's why we offer these webinars and these educational webinars that we offer.
And with our method, what we do is we take clients and kind of meet them where they are. And we use this 7 steps to make sure we build a financial future that's not only prosperous, but also secure and lets people be very confident in what they're doing. And with these 7 steps, we can meet anyone who's just beginning, or we're looking at kind of the 1 and 2 stages where we're looking at trying to maximize cash flow by limiting expenses, where we're looking at debt and maybe if we need to prioritize some of that debt payment, or if it's something that we can just kind of manage and live with, right? Lots of times student loans have a low interest rate and it's just something that we know is there, but we don't necessarily need to prioritize it. And so that's kind of the beginning steps. And then 3 and 4 is kind of when you're in the middle, you have a security net, you try to build up that. You might have heard the term emergency fund that kind of has 3 to 6 months of income or expenses set aside for you in case anything happens, as well as making sure you're protected, worst case scenario on the insurance side, right? Making sure that your loved ones are taken care of if for unforeseen circumstances come into play. And then 5, 6, and 7 are kind of what we specialize in and focus on once we get our clients there. And it's kind of prioritizing where they're at and long-term saving and investing and making sure money is working for you and your family, making sure you're set for retirement, prioritizing defending that long-term position, as well as when you're in that retirement or later stages in your life, preserving that estate, deciding what you want your goal to be with your money and move on for kind of the future and future generations, because we've heard generational wealth, and that is what we want to build for every single one of our clients. And so with that, there are kind of 3 main ways. It's kind of the short-term investing, which is kind of investing, kind of what we talked about for living expenses and kind of the short-term methods, and that's going to be less than 1 year. We might have that in like your checkings and savings accounts, or even in a money market fund in one of your brokerage accounts to kind of generate some higher interest. But that is for the short-term environment. Then there's long term, which is 7 or more years, roughly. Again, depends on each person's situation. But that's where a lot of the retirement planning comes into play, getting the tax advantages that we'll speak on a bit later, and prioritizing that. And then the last one is kind of the midterm, where we're focusing on larger expenses that might come into play, bigger vacations, a house, a car, some of that where, again, we don't want the money sitting on the sideline, but we want it to be building so that you can use it and use it to enjoy your life. And as we kind of mentioned, there are kind of those three buckets within each of those timelines, which is kind of a taxable account, which you don't get any tax advantages to, but it makes the money really liquid. You can access it and can use it throughout your life. There's the tax deferred, which is kind of what most people are more familiar with their 401k or and investing for retirement, where you can access the money 59 and a half or later and get tax deferred growth. So the money in the account grows tax free, but then when you take it out, you're going to pay that taxes. So you kind of get the tax break this year when you generated the income. And then tax advantage is our favorite bucket. That Roth IRA is extremely important, because it is that tax advantage account where you pay taxes now, but it grows tax free, which is great. And then when you take it out, it's also tax free. And with our environment where we think taxes will probably increase in the future, and just getting that long-term growth and compound interest, being able to take that money out tax free is hugely advantageous.
So let's talk next about the Rule of 72. Some of you probably learned about this in school, but most schools don't teach it. So Albert Einstein, that funny-haired guy, discovered this. It's a mathematical equation that, and we use it in our finance world, right? So if you take 72, you divide it by whatever interest rate you think you can get. So let's say you can get 4%. Where can you get 4%? Some CDs, some bonds, some fixed accounts pay 4%, but maybe not guaranteed lifetime, but it'll go up and down, fluctuating. So 72 divided by 4% is 18 years. So every 18 years, money doubles at 4%. You're 29 years old, you have $10,000. At 47, 18 years later, you have double 20,000, and then 65, you have $40,000. So then let's say you can get a little bit higher rate of return, maybe a 6% rate of return. So now 72 divided by 6 is 12 years. So at 29 years old, 41, it doubles again, 53, it doubles again, 65, you actually have 80,000. You're doubling one more time because you have a little higher rate of return. It's amazing, this mathematical how it all works. And then the next one is 8%. So 72 divided by 8 is 9 years. So now you have at 29, you have $10,000. 9 years later, 38 doubles, 47 it doubles, age 56 it doubles, by 65 it doubles one more time, you'd have $160,000. And then lastly, if you can get a 12% rate of return, 12%, 72 divided by 12 is 6. Now every 6 years it doubles. So it doubles again. So by the time you're 65, you have $640,000. So the education of how money works is important. Not all money needs to have, because usually with higher return, you have a little bit higher volatility and risk. Not all money needs to have that. But if your money is long-term focused, maybe you take a little bit more risk to have that Rule of 72 work on your side. But remember, it works against you too. So if you have credit card debt at 12%, it's doubling. By the time you're 65, you pay to the credit card company $640,000. So it can work for you or it can work against you. We want it to work for us. So the cost of waiting, two scenarios. Okay, you have someone on the left, age 25. They start saving right away, 24,000, right? They put from 25 to 45, they save 24,000. their gain is about 70,000. And by the time that they're 55 years old, they have 94,000 in that account. If you delay that and say, I just want to have some fun. I'm in my 20s. I want to travel. I want to do this and that. I don't want to put money away right now. I'll do that when I'm in my 30s. So now you're in your 30s, you're 35, and you say, okay, now it's time to save. So you save that same 24,000. Your growth is only 20,000 by the time your age, this is age 65. So total savings is the same thing, but by the time you're age 65, you have only 44,000, half, less than half of what you would if you would have just started saving in your 20s from 25 to 45. Isn't that incredible? The 10 years of that saving from 25 to 35 almost doubles, more than doubles the money that you have by the time you're 65. It's quite amazing. So start early, but start anytime, right? For some people, it could be in their 50s or 60s. Start anytime. Start saving anytime. This is just the S&P 500 going back to 1997. I was in the industry way back then, and we were heading into a lot of unknowns. The markets were heading up, but all of a sudden, what happened in the year 2000? Some of you remember that 2000, 2001, 2002, markets dropped 49%. So then how do you gain back what you lost there in those 3 years? It took all the way to 2007, almost 2008 to just break even. So if you lose 49%, you have to actually gain 101% just to break even. So now you're in 2008. What happened in 2008? The financial crisis. Again, it dropped 57% in about 2.5 years. By 2009, the market was down. Then it did jump up quite a bit in the next 10 years, but then it took a drop again, went up again in 2022, took a drop again, and went up again. This we call the roller coaster ride. Basically, through the years, stocks have done well, but if you're in the retirement mode or if you don't like to stomach the up and down of the market, because it does have up and down, sure, you can invest in stocks and stay with it for 30, 40 years. Some people can stomach it, some people can't. So it's important to understand we have other solutions too that can help minimize the volatility, potentially have that same opportunity for growth in different strategies in the market, but we also have the ability to minimize the volatility that does occur in a lot of strategies, a lot of investments that follow the market.
And one of these methods that we use and just kind of staying consistent when it comes to investing is called dollar cost averaging. So again, not necessarily a strategy that we use, but it's a method of staying consistent to your investing process and kind of building those muscles. And the whole premise of it is just you take a rather than a lump sum investment, you take that lump sum and average it out for a year. So in this example, rather than investing $800 at the start of the year, you do $100 each month. And the idea is you buy when it's high, you buy when it's low, you just stay consistent. And as you can see, if you had done the lump sum, you actually end up at a 0% return because you bought at $10 for $800, and then in August it's still $10. Where if you did monthly, sometimes you bought at $14, but a lot of times you bought 8, 8.5, 7.5, and are able to kind of make a 4.07% return, which is much greater than zero, right? And the whole premise of this is it can actually be extended periods, right? The idea of maybe you do invest in a Roth annually, but do that over a 10-year time horizon, that is still dollar cost averaging as long as you stay consistent. The time it breaks is if it's a high market and you get too scared because you're like, oh, it's at all-time highs, I can't invest. Or if it's super low and you get scared of the market and you're like, no, I just lost too much money, I don't want to do it. that's where the system breaks down. But if you maintain the consistency, as we kind of saw in that last presentation on that last slide, the inflection points, uh, that slide did go up and to the right. And that's what we are targeting.
And us women, we like sales, right? So when it's at $8 or $8.50, we're buying on sale. So that's when you buy your investment on sale.
Exactly.
So the sequence of returns, this is important, especially people retiring. There's two scenarios here we have. This is the first one. So if you start withdrawing from your investments, maybe your mutual funds, maybe your 401k, maybe your IRA, you're retired. Okay, now you want to start drawing. Maybe you want to draw 3-4% of your account value. So the markets are going up. Great. So year number one, market went up 27%. You withdrew, actually, you withdrew about 5% of that account, 50,000. Now it's at 1.2 million. So the second year market went up, third year, fourth year market went down. So so your account value went down. This, if you start investing into retirement during an up market, your account value will last, statistically, it'll last at least 30 years, 36 years. Remember, we have inflation there. So it's taking out the percent, but then it's also increasing with inflation. So if you take out less, even though we have inflation, you could even last, the money could last a lot longer than this. All right, so I think we're using about 3% for inflation. So you take out the 5% and then you add on top of that 3% inflation factor. So let's go to the next one. What if scenario two, what if you start withdrawing for retirement from your IRAs, from your Roth, 401k, but the markets are starting to head down. So this is year one, markets are down 15%. All of a sudden you're behind the 8 ball now. And statistically, and all they did is take a -15, +7, +9, +27. They just rotated it, right? So these scenarios are pretty accurate. But if you started when the markets are down, that's why we use different strategies to minimize the risk. That's why it's so important when you're close to retirement and you're going to start drawing from your account, make sure we look at the ability to minimize and help preserve those accounts, because it's so important not to draw from strategies that are in the volatile mode, because you're losing more. Just like dollar cost averaging works for you when you're investing and you're buying all through the highs and lows, it's the opposite. When you're drawing money out, you lose more money than you would if you were putting money in a volatile market. So in 23 years, there's zero account balance because you're drawing money when the markets are down or heading downward.
This is shown even on a greater scale, kind of the impact of losses, kind of talking about what we just uh, displayed in the sequence of returns, but the idea of how loss in the portfolio right off the bat actually takes longer to gain back, because you have to, if you lose 10%, you don't just have to gain another 10% to get back even, but you have to gain 11%, right? And so that is shown kind of in a larger scale here, where, again, if you lose 50% of your return right off the bat, you have to get 100% return. And that is really tough in any market environment to kind of get back. And so it takes 11, almost 12 years to get back to even, right? Back to where you started. And that's why it's really important to kind of use these strategies or use an advisor to kind of make sure that these losses don't occur and you don't make major mistakes with your portfolio and with your planning.
Mine or yours, Nathan?
Uh, I can take it.
Okay.
And so again, this is kind of shown in real versus average returns. A lot of times you'll see kind of an average return as your prime example of people's portfolio growth, but average return doesn't necessarily always tell the whole story. If you look at portfolio A, you're looking at an average return of 6.6. Portfolio B has an average return of 6.6. But the gain is significantly different, and that is because impact of losses, sequence of returns, what we just kind of talked about, the first year had a negative 40%, kind of that large roller coaster ride that Carla has mentioned, and that has decreased your $100,000 starting balance down to 60. And even if you have another 40% and a 20% year after that, which are great years, you are still only at an $800 gain. And you can say, oh, it's a 6.6% average return, but that doesn't tell the whole story. Where you look at portfolio B, where it's much more of a mitigated experience at a negative 10% and then plus 15, plus 15. So still start with a loss, right? Losses do happen. We're not saying that that's not part of the investing world. It's just mitigating that as much as possible. And you see that that average 6.6% return with kind of mitigated risk is still a $19,000 gain because we are limiting that risk exposure. So again, kind of which one is more important to you is a big factor of kind of the real versus average return.
So this is we call this the periodic chart of sectors. So every year, go back to 2010, 11, 12, look at the top, those are the dates, right? Different sectors are top performing. So 2010, REITs, real estate were top performing, small caps were second top. The bottom was cash. Cash, you didn't want to be in cash in 2010. Look at 2013, top performing, small caps. Bottom is commodities like grains and oil and gas and that type of thing. So you don't want to be in that. So if you're in an asset allocation or if you're diversified, you're in that middle space. See that with the white boxes? You're in that middle space. And what we try to do as much as possible is offer strategies and investments that are daily managed, that have the ability, number one, diversification in sectors, but also diversification in strategies to help, again, mitigate the loss, help increase performance, and also mitigate volatility. And this shows how diversification can be important.
And then, oh, go for it.
Go ahead, Nathan.
Yeah, and this is even more shown in this last one where not only diversification comes into play, but time. As we've kind of gone through this presentation, the one largest thing investors have on their side is time, right? The longer you have to stay in the market, be in the market, use strategies, the better and higher chances and probability of success are. And so if you look at the 1 year time horizon, and if you're just fully on that roller coaster in 100% stocks, you can have a plus 52% gain, but also negative 37. It is very volatile. Again, diversification, that 60-40 portfolio that you might have heard of, definitely decreases that roller coaster ride, but it's still very volatile in the 1 year time horizon. While if we just kind of switch all the way to the right to the 20-year investing time horizon, you see that your gain is 18% with the stocks, or loss of, I still think the bottom end's a 6% gain. And all three of those are actually positive because what we know is the market usually moves up and to the right. And so the three things that we have is kind of time and diversification can outweigh volatility.
You're gonna take this. Okay. So the emotions of investing. So this is really critical because a lot of people base they're investing on emotions. And so what happens is when we can't take it anymore, right? We can't take the great loss. We can't take what's going on in the media. We're listening to the news. We're listening to this and this. Markets are going down. We had some of that this past April, March and April. We had some of that where people were listening and it was causing emotion. What happens when you're emotional? You start to create fear. What happens when you have the fear? You want to just get out, you capitulate, right? You just want to get out of the market. So it's important to understand that we feel the way we feel during typical market cycles doesn't always mean it's the best decision to bug out or to make decisions based on emotion. We do our best in this world and in our investment world, again, to take the emotion out of investing and to help people so they have the ability again to help gain, but also minimize. So if you take the emotion out, it usually bodes well for a client to have long-term a greater possible positive outlook than to be emotional and to buy and sell or to sell or to make those decisions based on fear and emotion. Nathan, did you want to add something?
Yeah, I think we're good on that slide, but it's even shown more on this next one of kind of the behavioral mindset that people have, especially with their own money, where these strong emotions to seeing red on your account value can just cause instant kind of this gut reaction of hit the sell button, right? And lots of investors that try to do it themselves or think they can kind of weather that storm themselves. Some might, but this study shows that most don't. And while the S&P we know is a great tool to kind of gauge market success is at a 9.8% between this 20-year period, the average investor returned a 3.1% return. And this is because of those emotional decisions that kind of get in our way for success and why Carla, myself, other advisors at ClearStep are so advantageous to protect you from your own mistakes, from your own emotions that can really derail your whole plan. And why it's really important to just have someone overlook, someone, a second set of eyes, a second opinion, right? Lean on our expertise so that you can be closer to that 9.8% return and not at this 3.1 return, which barely beats inflation, right? And so that's why it's really important to, no matter how much you think you can manage the emotions, it is tough when they come into play. So,
And we appreciate everyone for being here. So what we offer new clients is a three-step financial process. Number one is we gather information. We have a 4-page fact finder that we go through, and we just want to see what the picture looks like. And the second step is ideas, strategies. If you're close to retirement, if you're in the beginning stages of saving, investing, we just help go through some of the recommendations and strategies. And then the third step is we implement what we recommend then. So that's our focus. Our goal is we want to help you through every step of the way. We want to help you through the accumulation phase and also through the distribution phase of your life. So with that, thank you for attending and reach out to the financial advisor that invited you here for any additional questions. Thank you.